All right, here we are. We're going to jump right into it because today is a very, very important lecture. Today's a lecture you might even want to watch twice, okay? So let's go right into it. I know one of the homework problems that I gave you was to finish up the Valentine handout. Is that correct? Okay, so let's go ahead and take a look at that. The answer to the income statement, I believe we went over that in class, but let's take another look at it, okay? The answer to the Valentine income statement is shown up there. We have our revenues less our expenses, and we have dated it properly or prepared it in good form or proper form, as I like to say. We have the name of the company, the name of the statement, and it's dated correctly. It says for the month ended 8/31/13 on the income statement, correct? All right, that gives us in this case a net income of $7,040, and that flows down to the statement of equity, right? Statement of equity, there's the net income right there, okay? Whoops, wrong way. We have our beginning balance of capital, which was $28,000. We add our net income. There were not any investments by the owner in this period. That's fine, that's not always going to be the case. And then we deduct the withdrawals that Valentine made, correct, which was $3,500. That gives us an ending balance of capital of $31,540. Once again, it's prepared in proper form. The name of the company, the name of the statement, and it's dated properly for the month ended 8/31/13. The way that this is dated will always be the same as the income statement. Okay, any questions on the income statement or the statement of equity? Okay, the ending balance of capital is $31,540, and that flows over to our final statement that we're going to prepare, which is the balance sheet, correct? The balance sheet is dated a little differently. We don't say for the month ended, we say just either at or as of or just the date, 8/31/13, because this is a snapshot, right? We have our assets, our liabilities, our equity. Total assets are $34,020. Make sure you label that. We have our total liabilities and equity that also equals $34,020. We want those numbers to be equal, and we want to label that as well. All right? And there's that $31,540 that came over from the statement of equity. Kara?
Accounts receivable is an asset and accounts payable is always a liability?
That's correct.
Okay.
Accounts receivable is always an asset. We're going to receive cash in the future, and accounts payable is a liability we're going to have to pay in the future. It's debt, okay? And notice going back to the statement, where's unearned revenue? Unearned revenue is a liability, right? And it shows up with the other liabilities on the balance sheet, right? Common mistake on the test is people put unearned revenue where? Where do they put it mistakenly? On the income statement, actually. They see revenue and they put it with the other revenues. Okay? So unearned revenue is not a revenue, it's a liability. Unearned revenue is a liability. All right? Cool? All right. That was a test question on past tests, so I guarantee you're going to have to do something like that. Okay? One thing that I hope you did is at the very beginning, and I've said this before, but I hope when you got this, you went through these and put what financial statement it was going to go on, like that, okay? And then did you like check them off as you used them? Okay? As you put them on a statement, you know, check them off. That way at the very end you can make sure that all of the numbers have been put somewhere, okay? All right, so if you don't do it that way, a lot of times people will forget to put an account. Okay, good. One last thing. I guarantee you that will be on the test, but some students will just absolutely get OCD in regards to, I can't get it to balance. They know their balance sheet's supposed to balance. I can't get it to balance. And I've had students be very unwise and spend 30 minutes literally on their financial statements on the test trying to get it to balance. And meanwhile, the rest of their test just sits there and they're not going over it. You see what I'm saying? Don't obsess over it, okay? If it doesn't balance, come back to it. Do the rest of the test, okay? And, you know, there is partial credit, okay? But don't get so obsessed. I have seen students leave 3 pages blank on their test because they're like, I couldn't move on because I couldn't get my balance sheet to balance. No, you can move on, and you should have moved on. You see what I'm saying? So be careful on that. All right, I believe I assigned, let's see, which one was it? Quick Study 1.6, is that right? Quick Study 1.6, okay. So let's do that, okay. Identify which accounting principle or assumption best describes each of the following practices. Okay, if $51,000 cash is paid to buy land, the land is reported on the balance sheet at $51,000. What would that be? The cost principle. We record things at cost, okay? Not what we think it's worth or what somebody appraised. No, it's what we paid for it, cost. B, Alyssa Keys owns both Sailing Passions and Dockside Supplies. In preparing financial statements for Dockside, Keys makes sure that the expense transactions of Sailing Passions are kept separately from Dockside's transactions and financial statements. What's that? Business entity. The business entity principle states that we keep things separate from each other. We keep 2 businesses separate from each other. We keep the business separate from our personal records, right? Okay, good. C, in December 2010, Ace Landscaping received a customer's order and cash prepayment to install sod at a new house that would not be ready for installation until March of 2011. Ace should record the revenue from the customer in March 2011, not December 2010. What's that? Revenue recognition principle. We record revenue when it is earned. When is it earned? When we have provided the product or the service. Is that correct? Cool. All right. I think the last one I assigned was exercise 118. Is that correct? Okay. Let's talk real quick about this. I wanted you to read about this. Each chapter will have a statistic. Each chapter has a statistic or a ratio at the end that they want you to become familiar with it. Okay. Anybody here play baseball? Anybody ever played baseball? Okay. Well, baseball has a lot of statistics and ratios that they figure out, right? Batting average, ERA, you know, all those sort of things. Slugging percentage, correct? Those are different ways of measuring baseball players or teams, right? And you could measure one player against another player, or you could measure one player this year as far as how they're doing this year as compared to last year, right? And these are just different ways of analyzing. Well, there's different ways of measuring companies and analyzing companies as well. One of those ways is the return on assets. Now, the return on assets is calculated by taking the net income divided by the average total assets, correct? And in this case, they tell us in exercise 118 that Geneva Group reports net income of $20,000 for 2011. At the beginning of 2011, they had $100,000 in assets. By the end of 2011, assets had grown to $150,000. What is Geneva Group's 2011 return on assets? How would you assess its performance if competitors average a 10% return on assets? Well, we take that net income of $20,000, divide it by the average total assets, which in this case is $125,000. 20 divided by 125 is 16%, right? Now, these ratios don't mean anything in themselves. We have to compare it to something. It's like, do you ever get you ever go to the doctor and they give you a score, like a cholesterol score? Your cholesterol score is 74. Okay? Is that good or is that bad? Right? We don't know. The number itself, we don't know. Okay? So in this case, what do we compare this to? Well, they tell us that competitors average a 10% return on assets. So I would say, looking at this ratio alone, it's above it, correct? And thus, as far as that ratio by itself, that's a pretty good thing, isn't it? Okay. Now, we have to look at other ratios, right? Just like when you go to the doctor, you can't just get one thing, one part of yourself analyzed and ignore everything else, right? Okay? And you also have to make sure that, like in this case, we compared this ROA to its competitors. That's a good comparison, right? But you wouldn't compare the return on an assets of a steel manufacturing firm with the return on assets of a law consulting firm. That's apples to oranges, right? Okay? So you want to make sure it's an industry comparison or a competitor comparison, or you're comparing it to that same firm at a different period in time. You with me? I don't hammer on the ratios. I usually have one multiple choice question on a test about it. It's not that it's not important. It's extremely important. And as a matter of fact, I just helped lead a seminar where we're trying to train people in the banking industry how to best use ratio analysis when assessing if they should give companies loans. Okay, financial statement analysis and ratio analysis is an extremely useful skill, and so. But we're just going to, in this class, we'll just kind of introduce these things. You'll see these terms in other classes that you take. Cool? All right. I think that's it for the homework, is it not? All right. Well, this is an important lecture, and I'm glad you're here. All right. We are going to go to Chapter 2, which is Analyzing and Recording Transactions. Now, I hope you all have your PowerPoints. For you at home, you should print those off the Angel website. It's under the Lessons tab. You should have the PowerPoints for each chapter. You should have those when you watch the lectures. It makes everything a lot easier. Okay? All right, Chapter 2, Analyzing and Recording Transactions. Now, let's just do a little review here. We have lots of transactions that occur in a business. Some are external transactions. They occur between us and an outside party. And some are internal. They occur within the organization. Okay? We know that assets has to equal liabilities plus owner's equity, correct? I've hammered that in. Said a different way, if we figure out the ending balances of all the assets accounts, they have to equal the sum of the ending balances of the liability and equity accounts, don't they? That always, always, always has to stay equal. Assets have to equal liabilities plus the equity. We talked about our assets, and I believe the assets on your screen here, I think we've talked about all of them. Whoops, notes receivable. That should be up there, but I think you can figure that out. I believe we talked about all of these except maybe prepaid accounts. Prepaid accounts are like prepaid rent. Okay? Let's say for my business, I didn't just pay September's rent, but I went ahead and paid September, October, November, December. Well, that's like I've paid the rent early, haven't I? Okay, that's an asset. That's prepaid rent. Something else in your own life that is a prepaid asset is your insurance, your car insurance. You have to pay for your insurance before you actually use it. Okay, it's an asset. As a matter of fact, if you canceled your policy, they would send you some money, right? Okay, so that would be prepaid insurance. Okay, so any sort of prepaid item in business is an asset. Okay, our liabilities, we talked about accounts payable, notes payable. We talked about how unearned revenue is a liability, not a revenue, but unearned revenue is a liability. Now, what's this thing called accrued liabilities? Well, that's kind of a title for a lot of different types of accounts. And we'll talk more about this in chapter 3, but this is like your salaries payable, your wages payable, your interest payable, taxes payable, those sort of things. Okay? So those are liabilities as well. And then, of course, we talked about our equity account. And we talked about what makes it increase, what makes it decrease. We talked about how revenues and owners' investments of assets into the company makes it increase. Expenses and withdrawals of assets by the owner out of the business makes it decrease. Once again, assets always has to equal liabilities plus owner's equity. And then we expanded that accounting equation, didn't we? Recognizing that these things, owner's withdrawals and expenses, since those actually make equity go down, as owner's withdrawal and as expenses increase, equity actually decreases. You with me? Now let's go through this, and this may not make a lot of sense, but we're going to go through it again at the end of the chapter and it'll make more sense. What we're going to do is we're going to analyze transactions and events from something called source documents. What are source documents? Source documents are those pieces of paper or electronic emails or PDFs or whatever that are generated when you do business transactions, okay? Source documents are those things that are generated when you do transactions. For example, let's say that you go buy a computer at Best Buy, okay? Well, if you go buy a computer at Best Buy, they're going to give you an invoice, right? That invoice is a source document, right? Let's say you get paid. Well, what are they going to give you? They're going to give you a check, and they're going to usually give you a paycheck stub, right? Okay? Let's say you go pay a parking ticket. Well, when you pay that parking ticket, they'll probably give you a receipt to show that you paid that ticket, correct? Right? Let's say that you get a bank statement. You have a checking account, and so you get a bank statement each month. That's a source document, right? And that'll show different things that you have done throughout the month. So all these pieces of paper that are generated, and they're not always paper anymore, a lot of them electronic, but these are evidence that a transaction occurred, okay? And we could go back to them if needed, all right? Okay? But source documents. What we do is we analyze the transaction and events from these source documents, and then we're going to record these transactions in what we call a journal. All right? Then we're going to post the journal to the ledger accounts, and then we're going to learn about preparing and analyzing something called a trial balance. Okay? Now again, this doesn't all make sense right now. There's a lot of terms we haven't discussed, but this is where we're going with this chapter. Cool? All right. Let's talk about what an account is. Okay? An account is a record of increases and decreases in a specific asset, liability, equity, revenue, or expense item. Okay? For example, going to the Elmo, we kept track of, for instance, cash, correct? And we would say cash increased by $3,000, right? And then cash increased by $500, right? And then cash, let's say it decreased by $300, and then it went up by, let's say it went up by $250, and then let's say it went down by $200, right? But that is an account, and we're recording the increases and decreases in that account, correct? We did that in chapter 1. And of course, we could figure out the balance of that account, couldn't we? What is the balance of that account? 3250? I think you're right. 3250, yes. Okay. That is an account. Okay. Going back to this. And it's a record of increases and decreases, in this case, cash, but we could do that and do that for every account, correct? Now, we'll come back to that in a second, but what is a general ledger? A general ledger is a record containing all the accounts used by a company. If you look at exercise 111, this is kind of an example at this point in our learning of a general journal, at least recording transactions this way. But it shows a lot of different accounts and the increases or decreases, and then it shows the ending balance, correct? Okay? So that is kind of like, exercise 111 is kind of like a general ledger per se. All right? Now, we are going to learn a new way of recording business transactions. We're going to do a transformation from the Chapter 1 way to the new Chapter 2 and beyond way. Okay? In a way, Chapter 1 is kind of like the training wheels on a bicycle. Okay? Did anybody learn how to ride a bicycle using training wheels? Okay? Well, the training wheels kind of help you get the feeling of how a bike should feel, kind of lets you learn your balance, how to turn. But eventually, what? Mom or dad comes with a crescent wrench and they take the training wheels off, right? Now, once you learn how to ride it without a bike without the training wheels, do you ever put the training wheels back on? No. You never say, you know, I'm going to go on a bike ride today, but just for old time's sake, I think I'm going to put those old training wheels back. No. Once you've learned, once you've taken them off, they're gone for good. And that's the way you ride a bike from here on out. So this is what we're going to do. The Chapter 1 way was the training wheel method as far as recording transaction. Chapter 2, I'm dad, I got my crescent wrench, we're taking the training wheels off. Okay? Now I hope you understand the Chapter 1 way. If you don't, what's going to happen? You're going to fall down and skin your knee, aren't you? Okay? So you folks at home, if you don't understand Chapter 1 and how to record transactions in that manner, watch those lectures again. Okay? But we're going to learn the Chapter 2 way now. And this is the way we'll do things. Okay? All right. Let's take a look back at that account that I wrote. Remember that cash account that I wrote? This was the Chapter 1 way. Let me tweak this thing a little bit. Okay? Let's say you all understand this, right? Okay. What if I wrote it a slightly different way? What if I wrote it this way instead? What if I decided to put the increases on the left side and the decreases on the right side? Okay? What would the balance would still be $32.50, right? Okay? You understand how that moved to this? Okay? So, would you allow me to do that? Instead of writing it like this, let me just put the increases for cash on the left side and the decreases on the right side. Well, let me go ahead and draw a line down the middle of that. Okay? So I put the increases for cash on the left side, the decreases on the right side. Okay, if I know that for cash I'm going to put the increases on the left side and the decreases on the right side, why don't we just go ahead and make one little bit more change here? And let me get rid of the pluses and the minuses. Okay? Let's just say I know the increases are going to go over here and the decreases are going to go over here. Okay? This is cash. And the balance is still $32.50, right? Okay? Do you understand the transition from here to here? Okay, for those of you who have had accounting in high school or college or whatever, you know that we have now prepared what? Do you know what this is? It's a T account. And the reason we call it a T account is because this part looks like a T. And this is going to be a vital part of the Chapter 2 way that you'll learn and use from here on out. Now, this is a T account because, again, this looks like a T. The left side of a T account is called the debit side, and the right side of a T account is called the credit side. Are you with me? The left side of a T account is called the debit side, and the right side is called the credit side. And we abbreviate debit with DR. And don't ask me why. I know it doesn't have an R in it. But the way we abbreviate debit is with DR. The way we abbreviate credit is with CR. Okay? You with me? Let's take a look at this one more time. This was the chapter 1 way. Then we kind of did this transition right here, right? And then I did this transition, correct? And I introduced these new concepts called the left side of a T account is the debit side, the right side is the credit side, correct? Now, going back to our PowerPoint, I have just introduced these new terms, debits and credits, and I want to make some big cautions to you, and please take heed here. The way your brain works is whenever it learns a new term or you're trying to learn something, you go out in your brain and you try to understand something, find something that you already understand and kind of link it up. This is the way your brain biologically works, okay? So if I introduce a term to you and maybe you understand the root term, you'll try to figure it out. Or maybe even in sports, right? When you're teaching somebody to swing the golf club easily, you might just say, just think of it like a baseball bat. Just swing the bat. Just swing the golf club, right? It's going and going out in your brain, finding something you do understand, trying to help you with this new concept. Well, that's understandably the way we work. But it can cause problems in this specific area, okay? Do not think of the way, when we talk about these new terms, debits and credits, do not think of the way that others use these terms, such as your bank. And I know your brains. Some of you, when I said this is the debit side, this is the credit side, you already started thinking about, okay, now, I know the bank says they're going to debit my account, credit my, maybe that has something to do with this. No, please don't go down that road. For our purposes, I want you to think of the debit is the left side of the T account. The credit is the right side of the T account. You with me? Another mistake. Do not think of your plastic debit cards and credit cards. Okay? Some of you did that. Now 15, 20 years ago, people weren't even that familiar with the term debit, but now we all have debit cards, don't we? So now they're like, okay, now I think, let me see if I can figure this debit credit thing out that Krug's talking about. I have a debit card, and no, don't even go down that route. Don't do it, okay? Debit means left, credit means right. Debit means the left side, credit means the right side. You with me? It would have made my life easier if thousands of years ago when these terms originated, if they wouldn't have used the terms debit and credit. I wish they would have used the terms lefty and righty or something like that, okay? But do not think of these things in any way except that debit means the left side, credit means the right side. Do not mistakenly think of debit as debt and credit as the world defines them, like we're going to give you a line of credit or something. Don't do that, okay? For accounting, debit means left, credit means right. Do not mistakenly think of debits as good things and credits as bad things. This is another problem some students have had, okay? Once again, debit means left, credit means right. You with me? Can I pound that in any harder than I am, right? One more time. Debit means left, credit means right. Let's just say that as a class. Ready? Debit means left, credit means right. Okay? That's what I want you to concentrate on. Are you with me? Now, let's go back to this account that I showed you. if you look at this cash account, you might understandably but mistakenly think, okay, debit means increase and credit means decrease. No, debit does not mean increase, credit does not mean decrease. Debit means the left side, credit means the right side. You with me? Yes, for cash, specifically for cash, yes, the increases are on the debit side and the decreases are on the credit side, but that is not always the case. Let me give you an example. Let's take a look at a different account. Let's take a look at an account of notes payable, which is a liability, right? Now, this is a T account for notes payable. What's the left side called on a T account for notes payable? The left side, regardless of the account, the left side is the debit side, the right side is the credit side. Always, 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 regardless of the account, the left side is the debit, the right side is the credit. Cool? Now, I told you that for cash, increases are kept track of on the debit side, and that is true. However, for notes payable, increases are kept track of on the right side or the credit side. So let's say we were going to increase notes payable. Let's say we were going to increase notes payable. I would show that on the credit side. Are you with me? For notes payable, increases are on the credit side. That's why we can't say debit means increase and credit means decrease. No, 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 no. Debit means left, credit means right. Some accounts, the increases are kept track of on the debit side. Other accounts, increases are kept track of on the credit side. Are you with me? Cool. One thing, and then I'll answer your question. When I wrote that 500 here, that is called crediting the account, crediting the notes payable account. When I wrote that 500 on the credit side for notes payable, that is called I credited the notes payable account because I wrote something on the credit side. You with me? When I wrote this 250 for cash, that's called, for accounting purposes, I debited cash for 250 because I wrote 250 on the debit side for cash. Cool? Kara, do you have a question?
Yeah, when you write it, on this new way, you don't want us to put like a plus or minus. You just want us to write it.
Question. That is a great question. That is exactly true, Kara. Never, ever, ever do I want to see dollar signs or pluses or minuses in a T account. Okay? Good question. Great question. No pluses or minuses, no dollar signs in a T account. Cool? All right. Now, let me switch over here. Actually, keep it off there. Keep it on me for a second. And let me go to the next thing that I want to show you. Okay, we've been talking about two accounts here. Let's think of the way we recorded things in the Chapter 1 method, and let's go to the Elmo now. Let's say we got a loan for $5,000 from the bank. Okay? We got a loan of $5,000 cash from the bank. Well, the Chapter 1 way we would say cash plus 5,000, and we would say notes payable plus 5,000. Isn't that the way we would have done it? Now let's learn the new way of recording this. Well, let's do T accounts. I'm going to do a T account for cash, and I'm going to do a T account for notes payable. Okay? Now we know that the left side of the T accounts is the debit side, correct? And the right side of the T accounts is the credit side. I also told you that increases for cash are accounted for on the debit side, right? So I'm going to debit cash for $5,000, which means I increased cash for $5,000 because increases are on the debit or the left side. Now I'm going to credit notes payable for $5,000, and I'm increasing notes payable because I told you that increases for notes payable are kept track of on the credit side, right? This was the chapter 1 way. This is the chapter 2 way. And that's how we'll be doing things, okay? And as Kara said, there's no dollar signs, there's no pluses or minuses. Are you with me? Okay. Question?
Does it, for the notes payable, does the $5,000 go on the credit side because it's actually decreasing?
No.
Equity?
No, go back to it. And I know where your brain is going, and I'll point that out in a second. I've told you that increases for cash are kept track of on the debit side. Cash increased, so I had to write it on the debit side. I've told you that for notes payable, increases are kept track of on the credit side. And notes payable did increase by $5,000, so I had to put that on the credit side. Where your brain is probably going is saying, okay, you've told us that cash increases are on the debit side, and for notes payable, increases are on the credit side. How do we know an account is which side we do it? Okay, but notes payable is increasing. Okay, now that goes to the PowerPoint. An account that is called a debit balance account, an account that is called a debit balance account increases when you debit it and thus decreases when you credit it. Cash is a normal debit balance account. Cash is a normal debit balance account. Thus, it increases on the debit side, it decreases on the credit side. You with me? But there are also accounts called credit balance accounts, such as notes payable. For credit balance accounts, the increases are on the credit side and the decreases are on the debit side. Notes payable is a credit balance account. You with me? Now, all accounts are debited and credited at times. Okay? Sometimes people think, okay, so a debit balance account can only be debited. No. All accounts are both debited and credited. We just have to know for that specific account if when it's debit, if that means it's being increased or decreased. Are you with me? Okay? Another thing. Regardless of the account, opposite sides of the line, opposite effects. So if this is an increase, then this side is a decrease. If this is an increase, this side is a decrease. Opposite sides of the line, opposite effects, right? But in this case, they both increased. The increase for cash is on the debit side. The decrease for notes payable is on the credit side, right? Now let's say this was a zero interest loan and we used $300 cash to pay off some of this principal balance. Let's say there's no interest. Well, we pay off $300. Cash goes down by $300, right? So we show a decrease on the credit side, correct? For cash. Notes payable, where do we keep track of decreases? On the debit side. You with me? So all accounts are debited and credited. We just have to know that cash is a debit balance account. Thus, debits increase it and credits decrease it. And notes payable is a credit balance account. Thus, credits increase it and debits decrease it. You with me? I know I'm throwing a lot of information at you folks. Okay? Now, the best question that could be coming into your brain right now is, all right, can I borrow this there, Jake? Which accounts are debit balance accounts and which accounts are credit balance accounts? Okay? It's not, you have chapter 2? Here, let me grab this. Where's chapter 2?
pretty sure it is. Let's check this one.
Okay. Maybe I didn't bring that. Okay, I think I gave that to you in a separate one. Okay. All right. But the most logical question at this point is which account is a debit balance account, which account is a credit balance account. Okay? Now, let me turn in your book and I will show you what I'm talking about. Okay? All right? Turn to page 63. Okay? And you're going to see at the bottom, on the bottom right on page 63, a little chart like this. Okay? And this tells us that assets are normal debit balance accounts, thus they increase with a debit, and thus credits decrease them, right? And you're going to see liabilities, like notes payable, are debit balance accounts, correct? Thus they increase with a debit, and they decrease with the credit, okay? Now, this is all good and fine, but that's not the way to learn this. That is not the way to learn which accounts are debit balance accounts and which accounts are credit balance accounts. Here's what I want you to do. I want you to prepare, even in this age of technology and iPads and all this stuff, what's the best way to learn these? Flashcards. Flashcards. I want you to learn this by flashcards. Okay? Now, for example, here's one I made for cash, and I'm not just going to do a flashcard for assets. I'm going to do this for all sorts of assets. I'm going to do it for, let me back up. I'm going to do it for cash. I'm going to do it for buildings. I'm going to do it for notes receivable. I'm going to do it for supplies. Are those not all assets? Okay. Here's what I'm going to do. On one side of the flashcard, I have the name of the account. On the other side of the flashcard, I have cash is a debit balance account. Thus, a debit increases and a credit decreases. Are you with me? Cash is a debit balance account. Thus, a debit increases and a credit decreases. You with me? Now, I even went a little further on this flashcard, as you can see on it, and I said in the lower left corner, I said that it is an asset, and in the right side, I said it is on the balance sheet, right? That is a great flashcard. Now, mine looks all pretty, but you can do yours on index cards or whatever, okay? On one side, you put the name of the account. On the other side, you put that information, okay? Now, you want to do this for all of your accounts. For example, let's just say that this is a blank. Where's my pen? Let's just say that this is a blank flashcard. We learned notes payable today, right? So put notes payable on one side. And then on the other side, you can say, is a credit balance account. Therefore, a credit increases and a debit decreases. You with me? And then you could say down here if you want liability and where does the notes payable go? The balance sheet, correct? But I want you to think of all your different accounts that you have used, and I want you to learn your balances, okay? I want you to learn your account balances. I cannot stress this enough. You have to learn your account balances. You have to know which accounts are increased with a debit and thus are debit balance accounts, and which accounts are increased with a credit, and thus are increased with a credit. You have to know this. If you don't learn this, if you're stubborn and you're saying, Krug, I don't want to learn this, you should drop the class. Okay? I mean, I don't mean to be so dramatic, but you cannot do accounting unless you know this. Has anybody had accounting before in high school or something? Okay. Let me ask you this. Is anybody here taking a math class at JCCC? Jake, you are? What are you taking? Stats. You're taking statistics? Okay. Nobody else is taking a math class?
I'm done.
You're done?
I'm
Okay.
putting it off.
What?
I'm putting it off.
All right. You're taking statistics, okay? That's a math class. Nobody's here taking college algebra or you are? What's your name back there?
Brian, well, I'm taking calculus right now.
Oh, you're taking calculus?
Yeah.
Okay, Brian is taking calculus. Okay, let me give a quiz. I'm going to give this quiz to just Brian. And I don't want you to be smart, Alec. Just look at the quiz, and I want you to answer this for me, okay? 1, 2, 3, 4, blank, 6, 7, 8, 9, 10. Okay, I want you to think about this. Don't be a smart Alec. But Brian, what is the answer that goes in that blank?
5.
5. Very good. Give him a round of applause. Yay. Now, let me ask you this. Let's say that Brian did not know what went in that blank. Okay? Let's say he thought the answer was 4. Matt, how do you think Brian's going to do in calculus?
Probably about as good as I would.
Okay.
Not very well.
Not very well, is he? What if he had to really think about this for a while? Do you think he's going to do good in calculus? No. What if he thought the answer was -2? Or what if he thought the answer was pi? Or 1492 or Abraham Lincoln? If he doesn't know what goes in that blank, and if he doesn't know it quickly, he is going to flunk calculus in a very bad way. Am I correct? All right? You have to know this. You have to know this. Now, you don't know the full implications of everything I'm telling you right now. Okay? Remember when you learned your multiplication tables when you were a kid? And you would learn that 2 times 3 equals 6, right? There was a point in your learning that you just memorized that 2 times 3 equals 6, right? Later on, you might have realized that 3 times 2 also equals 6. Or that 6 divided by 3 equals 2. Or 6 divided by 2 equals 3. Or if you have 6 cookies and 3 friends, you each get 2 cookies. Or that you can even graphically represent 3 times 2 by going 3 rows of 2 or 2 rows of 3, right? But at some point in your learning, you just had to memorize 3 times 2 equals 6, correct? And then that other thing came about with more knowledge. That's where you are now. You don't fully understand the implications when I say cash is a debit balance account. Notes payable is a credit balance account, but you need to learn this. If you don't know this, you will not do well in the class. I used to do tutoring when I was at Kansas State University, and I'd have a student call me, and they were in chapter 4 or 5, and they would be flunking the class, and so they'd call for help, and so I'd go over there and try to help them. The first thing I would do is I'd give them a quiz on their account balances to see if they knew which accounts were debit balance accounts, which accounts were credit balance accounts. And if they didn't know it, I told them that you probably should just go drop the class. Just like Brian, I would tell you, if you don't know how to count to 10, should you be taking calculus? No. Okay? Can I say this strong enough? You folks at home, you need to make your flashcards. I'm going to email you a list, or it'll be posted under Chapter 2 on Angel, a list of the accounts and what their balance is, so that you can use that to make your own flashcards. Okay? I will give this to you guys as well. But you need to know which accounts are debit balance accounts and which accounts are credit balance accounts. Here's how you'll know somebody's flunking this class. If in 3 weeks from now, if I'm working with someone and I go, hey, John, okay, work with me. Now, is cash a debit balance account or credit balance account? And he's like, oh, it's a debit, credit, no, debit? No. John, you're flunking, right? If I ask you your middle name, do you have to think about it? No, you know it. That's what I want you to be with these accounts. Cash, debit balance account. It increases with a debit, it decreases with a credit. Notes payable, credit balance account. It increases with a credit and decreases with a debit. You understand? Can I make this any more clear? All right. Make your flashcards. The difference is not between those who want to do flashcards and those who don't. The difference is between those who, by the time they go to bed tonight, they have their flashcards made, versus those who, I'm going to do that tomorrow or next week. No. Do it tonight before you go to bed. Have your flashcards. I showed you an example of what they can look like. All right? One last thing, and I will let you go, is let me give you your homework. Okay? And do them in this order, if you would. But I want you to do quick study 2.1, 2.4, 2.5, 2.3. But more important than that, I want you to make flashcards. Okay? Are you with me? All right, guys, this is an important lecture. Watch it again if you have to. All right, we'll see you later. Bye-bye.